The stock market is a mess right now, or at least that's what it feels like to me. Markets are softening. I'm online trying to research and find information on what to do, and maybe you're like me and some of the investments you've made just don't seem to be panning out. If this is you, I want to talk a little bit about why you might be finding this stressful and maybe what changes you can make to relieve that stress. And I'm going to look at some tips from Warren Buffett, because although he sometimes loses in the markets, he definitely wins a lot more. If you've suffered a particularly big loss on an investment, it might just be a good idea to take a few days off of the computer. Give yourself a break from being bombarded by tons of information about stocks, and really think about if it's taking a mental toll on you. If it is, there's no shame in trying to address that first and foremost. A recent poll I did shows me that a lot of viewers on here have started investing in the last couple of years, and if one of these dips could become a cooling off period for the markets, that will be a first for many of you. It's common for the whole market to dip or cool off, and this is something all investors encounter eventually. It's actually a good thing. We've just been very green with everything going up for the last while here, and know that a loss is truly a loss only if you don't learn from it. Think about what you can learn from this experience, and that can help you in future ones. Now, Warren Buffett often mentions three major guidelines on how to not lose money in the stock market. First one is to avoid speculation, so don't invest based on other people's opinions, including mine. Invest in good quality businesses you understand, so stay away from things you don't understand. And three, buy when everyone's panicking. It's a little bit different from timing the market, but we'll talk about that later. So I'll sort of give you my spin and experience with these tips from Buffett that will hopefully identify what might have gone wrong that have caused you to lose your money. Watch until the end, because I have a personal story or tip in there too that I don't hear a lot of others talk about. The main way we humans lose money in the stock market usually have to do with emotions. When things are going well and the market is going up, we are loving it, but even then we have FOMO and invest because we don't want to miss the boat on a particular stock. We are in the euphoric cycle of investment, and we have buddies buying Tesla or Palantir, so we do too. Maybe we even looked at the financials, but the market price doesn't always, almost never, follow the fair value of a stock. So we jump in and the stock climbs a tad, but soon loses momentum and starts to dive. Now, things are going red and we're starting to say, well, I'm in this for the long term, or I still believe in the company will do well. There were people telling me Tesla was going to go to $1,000 this year. Am I still waiting? But the stock may continue to go down, and eventually we decide to cut our losses, often at the wrong time. So before picking a stock, ask yourself, if it started to go down, would you be fine with that? And if you say no to that question, it's a bad investment for you. To be able to say yes to those questions, you have to do two things: be familiar with the business and also smash that like button. Being familiar will make it so you're not panicked if the price goes down. You know the company is healthy, won't go bankrupt, and in fact, you may buy more while it's on sale. The other part to navigating this is to have a longer-term goal for your investments. Rather than trying to day trade and make money in a few weeks, having a goal that is out a few years will hopefully mean you don't need the money right away and can ride out any ups and downs. Now, if we've been investing a while and finding some success, we can sometimes fall into the trap of thinking we can beat the market, often by trying to time the market. You haven't heard of that? That's simply waiting for the dips to do your investing. Even experienced investors can fall into this way of thinking. Now, I know where this comes from. We look at a stock chart of something like the index and we go, oh, look, there are some dips, so if I just buy in those dips, well, then I'll maximize my return. But the saying hindsight is 20/20 is never more true than in investing. Remember that each one of these dips started a conversation about, is this the crash, the major recession that has been prophesized for years? Each dip was a cliff when you couldn't see the rest of the chart ahead, right? So then you are glued to your phone, reading articles all day, trying to see, how can I figure out if I'm at the bottom of the dip, or will it continue further? You can't. What if one of those dips does turn into the crash? Then, well, all that stress spent trying to time the markets is for nothing anyway. Studies show that investing only in dips will not give you as good of a return as dollar cost average Joe here, who has just been buying at regular intervals. Markets go down, he gets more units. Markets go up, he's buying less, but it's going up. And if it dips, he gets some on a discount and so on. If it crashes, he's averaging down as the markets get lower and lower, and when a recovery starts, all of that is going to pay off in spades. Now, there's a small caveat here. I will say, yes, buying the dip is a good practice if you are already buying an index fund over regular intervals. It's something I've done before. If you have some side money, and again, are thinking long term, this is fine. I wouldn't call it timing the market, because you're not trying to constantly sell at highs and buy at lows. When I was playing basketball growing up, sometimes we would be having a terrible game, so the coach would call a timeout and maybe change up the lines. And to calm us down, he'd remind us we just gotta stick to the fundamentals. Sometimes in the finance space, due to access to a ton of information or info that is sent to us, we start to forget some of the fundamentals of being a good investor, and we start to look at articles or data that starts to turn us into day traders. And this is a slippery slope to go down where you can really start to invest emotionally. So if you're finding yourself yourself losing money, ask yourself these fundamental questions about how you're going about your investing. Number one is straight from Buffett. Do you know the businesses you're getting into? Do your own research so that prices fluctuate. You won't be stressing and debating to keep your stocks or not. You should find companies where, should the price go down, you would actually look at buying more stocks. And if you can't say that about a company you're about to buy, don't buy it in the first place. You're just buying for FOMO. Second, do you know your own risk tolerance? That also means knowing the goals for your money. Is what you're investing in matching those goals, matching your timeline? And can you stomach dips in the account in the short term? Because if you've done your homework, you have given yourself a good chance to make money, but it's not going to happen overnight, and stocks are still subject to a lot of small forces along the way to long-term growth. Now, my personal big tip to control emotions during recessions and corrections: did you set up your emergency fund? But hear me out on this because it's a true story. So in March 2020, the stock market is sinking like a boat anchor. Everything was uncertain. The whole economy was in question, including my job, because Russia and Iran couldn't come to an agreement about how much oil to produce, which sunk oil prices and put my job in question. Now, should I have lost my job and needed money, where would that come from? With no emergency fund, I would have been drawing from my own accounts, having to sell investments at a low, and that would have been a big loss. But because I had an emergency fund, I was confident we'd be okay should I get fired or laid off. So I pulled together a bit of money outside of the fund and actually bought more of the index and a few dividend stocks that I had my eye on. Without that in place, I would have been in a very emotional headspace and not a good spot to make investment decisions. So if you find the market stressful, go back to your goals, assess your timelines, and get back to the fundamentals that you're familiar with, which should take some of the emotion and stress out of these decisions. Now, you know I wouldn't be making this video if I didn't experience losses in the market myself sometimes. So these are ways to check in with yourself, but a big thing to realize is that if you've lost money in the markets, you're not alone. It's very easy to feel isolated after making some of these mistakes, but here it goes. If you want to see some of the blunders I've made recently, check out this video and hopefully it makes you feel a little bit better.